Welcome to the deep dive. Today, we're digging into something pretty dramatic that happened recently. What looked like just another market blip, but actually, it showed some serious cracks in the system. We're talking about the sudden gold price crash on October 21st, 2025. And our goal here isn't just to, look at the price chart. We want to go deeper and uncover the, let's call it structural vulnerability, the hidden risk that this one event kind of flashed a spotlight on. And yeah, the event itself was pretty shocking. Gold dropped. What was it? A stunning 5.7% in a single day. Ended up around $4,087.70 an ounce. I mean, that's the biggest single day fall we've seen in over a decade for gold.
It was incredibly sharp, really violent move downwards. But here's the really interesting part, the paradox for you listening. Even with that huge drop, gold is still up over 50% for 2025. So it shows this strange mix, right? Strength, but also fragility. And it tells us this crash wasn't really people losing faith in gold, not fundamentally. It was more like a sudden, sharp distress signal from the cash markets.
Okay, let's start right there then. The mechanics. How does an asset that's supposed to be the ultimate safe haven suddenly fall off a cliff like that? Our sources point to the run-up. Gold was way overbought after, 9 straight weeks of rallying, pushing past $4,380.
Yeah, I just saw some reports talking about technical signals, just, screaming exhaustion. For listeners who aren't glued to charts, things like the relative strength index, the RSI, being above 80, what is an RSI that high plus those extended Massey signals?
Right.
What does that actually signal to traders?
It signals danger, basically. It tells the market the price has gone too far too fast. It's like running a car's engine in the red zone for too long. Something's got to give, right? The RSI hitting 80 means momentum is stretched thin, very thin. That rally just wasn't sustainable from a technical standpoint. So when the price finally broke below key support around $4,190, that was the trigger. All the automated trading systems, the algorithms that react instantly to these breaks, they just unleashed. And that started a massive cascade of selling, forced liquidations, too, from leveraged positions. Right, like a chain reaction. But you mentioned something crucial earlier, the reason people were selling. If gold's the safe haven, why dump it?
Yes, that's the absolute key point here. This wasn't really speculative selling, people betting against gold's future. No. Experienced traders immediately saw parallels to the March 2020 dash for cash. I actually spoke to someone on a liquidity desk that morning, and they basically said, everything's for sale. Doesn't matter what it is, we need dollars now. People, institutions, they were forced to sell safe assets. Treasuries, yes, but also gold. Not because they disliked gold, but out of sheer necessity. They needed cash instantly to cover margin calls, maybe unexpected losses popping up somewhere else in riskier parts of their portfolios. Gold effectively became the emergency ATM they had to raid.
So gold wasn't the problem, it was just collateral damage.
Yeah.
The system itself was desperate for cash. Okay, that completely shifts the focus, doesn't it? Away from just the gold price, towards the bigger picture. If even safe assets get dumped for survival cash, the real issue must be liquidity. Or rather, the lack of it. Let's dig into that. Where did all the cash go?
Exactly. We're talking about the financial system's plumbing, the pipes that carry cash around. And that October crash was a clear sign that the pipes are getting clogged, that cash is drying up. And the stress points, they start right at the heart of the U.S. system, the Federal Reserve. Some former Fed insiders have been raising red flags, saying U.S. bank reserves, the actual cash banks keep parked at the Fed, have fallen near or maybe even below critical levels, around $3 trillion. Now, that sounds like a huge amount of money.
Right, $3 trillion.
But in the context of the whole system, historically, when reserves get that low, the short-term money markets, the really crucial overnight lending stuff, they can just seize up, freeze.
And wasn't there supposed to be a massive buffer for exactly that kind of problem? The reverse repo facility?
Precisely. The overnight reverse repo, the RRP. That was meant to be the big shock absorber, where money market funds could safely park excess cash overnight. At its peak, it held trillions, acting like the system's emergency fund. Well, that fund is now largely gone, depleted.
And why? What drained it?
Quantitative tightening, QT. That's the Fed actively sucking money out of the system. They've been shrinking their huge portfolio bonds, letting up to $95 billion in assets roll off their books every single month.
Okay, I see the connection. QT pulls money out, bank reserves drop, the RRP buffer gets used up. Yeah, that sounds like a recipe for things to grind to a halt. How close are we, really?
Well, indications are, from recent briefings, that QT might end much sooner than planned. And it's not because, inflation is totally defeated.
Yeah.
It's because officials are quietly admitting that continuing QT risks, breaking the plumbing
Hmm.
destabilizing the whole financial architecture. They're worried about crossing a line where reducing liquidity actually causes an accident. That gold crash, that was the market screaming, hey, you're getting dangerously close.
Okay, and this is where it gets really interesting for me because this stress, it's not just contained within the Fed system, is it? It's sending ripples out globally, affecting parts of finance most people don't even think about, like private credit.
Oh, absolutely.
Yeah.
You have to look beyond just the regular banks. There are reports highlighting serious instability brewing in that massive private credit market. We're talking, what, $1.5 trillion,
Yeah.
maybe more? And it operates largely outside the normal regulatory oversight.
Word of $0.5 trillion.
Wow. Yeah, it boomed when interest rates were basically zero.
Yeah.
Companies borrowed directly from these private funds. But now, with higher rates, rising corporate debt, these deals are under pressure. If loans start souring in that huge sort of shadow banking world, the risk of contagion is serious,
Right.
especially because, well, let's just say transparency isn't its strong suit,
So it's like a black box amplifying the risk.
pretty much.
Yeah.
And there isn't enough clear liquidity there to handle widespread problems. So, yeah, global risk definitely goes up.
It feels like pressure is building everywhere, from the Fed's big balance sheet decisions down to these less visible private deals.
Yeah.
And what about regular people, households? Are there similar strains showing up there?
Yes, definitely. While the big institutions worry about QT, you see a parallel story playing out with consumers. U.S. consumer debt is now, it's staggering, over $18 trillion. And the really worrying part is that delinquencies, people falling behind on payments, defaults, they're ticking up. Now, above pre-pandemic levels in many areas. It's not just numbers. These are cracks appearing. It shows an economy that might look okay on the surface, but underneath, it's straining under reduced liquidity, the rising costs of servicing all that debt.
Which brings us neatly to the great paradox of this whole October event. This is the bit I really struggle with. While all these private players, funds, individuals, leveraged outfits were desperately selling gold to get cash, the big official institutions, the central banks, they were doing the complete opposite. Hold on, though. If central banks are loading up on gold and reserves are at record highs, doesn't that kind of contradict the whole dash for cash narrative? Are we seeing like two different markets here? Governments are calm and buying while everyone else panics.
That is precisely the contradiction, and you've nailed it. It's deeply ironic. The panic selling we saw, that was short-term, cyclical,
Yeah.
driven purely by an immediate lack of liquidity. But the central bank buying, that's long-term, strategic, structural. As private money fled from gold to grab temporary cash, the official sector was steadily moving towards it. Global central bank gold reserves hit, what, 36,359 tons by late 2025. That's the highest they've been in modern history.
36,000 tons.
And the data is specific. Just in August, they added another 15 tons, led by countries like China, Poland, Turkey. Consistent buyers.
So this isn't just them seeing a dip and buying low, it's strategic diversification. I think the World Gold Council said nearly half of central banks plan to increase their gold holdings next year. What message are they sending? What's the underlying drive?
The message is quiet but powerful. It's a gradual, deliberate shift away from relying so heavily on fiat currencies, especially the US dollar, and a move towards tangible, sovereign assets they hold themselves.
Yeah.
Gold. It's essentially a slow-motion, silent remonetization of gold, driven by declining trust.
Huh?
Declining trust in future monetary policy, in currency stability, especially after years and years of massive money printing, QE, around the world.
Right.
So while private investors might see gold as that emergency ATM, central banks increasingly see it as a vital hedge, a hedge against geopolitical risk and, frankly, eroding faith in the value of paper money.
That synthesis makes sense. So the October sell-off wasn't gold failing as a safe asset, which is how some headlines might have spun it.
Exactly. It wasn't about gold at all in that sense. It was like holding up a mirror to the financial system. A mirror reflecting just how fragile the liquidity foundations have become. The key lesson, I think, is this. Liquidity is not the same as stability. When a crisis hits and the cash needed just to keep things running suddenly vanishes, even the most trusted assets, like gold, have to be sacrificed short-term just for survival. We've seen this cycle repeat since 2008, haven't we? Risk builds up, hits a liquidity wall, forces emergency action.
So what does this all mean for you, the listener, trying to make sense of this? Forget just buying or selling gold for a moment. What's the bigger takeaway from this correction?
I think the correction serves as a really important diagnostic tool. When gold behaves this violently, it's signaling something about the trust in the monetary system, not just its own price swings. If gold is being dumped forcefully like that, it means the core plumbing the cash flows, the buffers, is under serious strain. Understanding those underlying liquidity dynamics is it's crucial for judging the health of the entire system, right? It goes way beyond just your own portfolio. It's a fragility indicator for the whole financial architecture.
Exactly. That steep drop on October 21st was a warning shot. It exposed how fragile things are, forcing the Fed to apparently rethink its tightening path, and all while central banks keep quietly stacking bullion. That two-tier market is very real.
Yeah, the main takeaway is pretty stark. The global economy really runs on confidence, much more than on actual physical cash day to day. But that liquidity crisis showed us when the cash needed for basic functioning dries up, that confidence could evaporate incredibly fast. And it's in those moments, historically, that gold tends to reassert itself as the ultimate benchmark of monetary trust.
Which really leaves us with a final thought for you to mull over. Our whole global financial system seems built on the promise that central banks can and will step in with liquidity whenever panic flares up. But how durable is a system built so heavily on just belief, on trust? Especially when its fundamental plumbing keeps showing signs of seizing up like this. Something to think about as you consider what real financial security looks like. Until next time.